Okay, hi everyone, this is Finance Meets Real Estate. So as you guys know, we do weekly webinars every Tuesday. We have a great guest here today. It's my friend Marc, Marc Weisi, and his partner Gonzalo Trenosky. So they're going to talk about their first multifamily deal that they did. And it's a multifamily syndication, 32 unit in Louisville, Kentucky. So Gonzalo is a full-time multifamily investor. He is previously, he comes from an engineering background, and he was a partner at MFS Consulting Engineers and Surveyors. He has a master's in engineering from Stevens Institute of Technology and bachelor's in civil engineering from Rochester Institute of Technology. He's currently a limited partner on over 170 units and a general partner on 39 units. And Marc, so Marc is a friend of mine from New Jersey. He's a multifamily investor with a background in financial analysis and modeling, investor relations, technology systems. He's a portfolio manager at UBS, where he oversees billions in clients' assets. He obtained his CFA charter in 2016. And he also has a real estate portfolio of 5 million in assets, including both active and passive investments. He holds a bachelor's degree from Bachelor's of Science from Stevens Institute of Technology. So with that, so we're going to do a more open, conversational format today. Like I said, the primary topic is getting your first multifamily deal done. So, Marc and Gonzalo here have been able to do this on a syndication deal, and they will share their experience. If you guys have any questions, feel free to speak up, or you can put your questions on the chat as well. And this recording of this webinar is going to be on YouTube as well. So with that, awesome. I'm going to pass it on to you, Marc and Gonzalo, and I'm going to be here with my own questions, I'm sure, and others as well.
Yeah, anybody feel free, as Stefan said, feel free to either talk your questions or throw them in the chat. Want this to be definitely organic and free flowing. So welcome everybody, and myself and Gonzalo, as Stefan talked about, just in September, took down our first true lead GP deal, as you mentioned, a 32 unit deal in Louisville, Kentucky. So I first want to take a step back and talk about kind of what led up to that deal, and Gonzalo, definitely feel free to jump in if I missed anything along the way. If there's one thing I guess that I can kind of start with, was this definitely wasn't an overnight acquisition where, we went to a conference, a weekend boot camp, and then, we decided we're going to get into multifamily, and, the next weekend we had a deal under contract. It was a long slog. At times, we would see, we were on a lot of newsletters and things like that for other sponsors. We see people getting deals across the finish line, and sometimes we wonder, why not us? We're underwriting deals, we're talking to brokers, we're visiting the local market, and doing all the things that we were kind of taught to do, but it still took us kind of a year and a half to 2 years roughly to get this deal. So definitely for anybody who's looking to do their first deal, don't just get discouraged, keep at it, and with enough of the right action, it's going to happen. So with that, I could talk about how we found the deal, and Gonzalo, feel free to jump in at any point. Sure. But this deal, unlike, I guess, most of what trades, it was not through a broker. This was actually through a sponsor relationship that we had. So it was a sponsor we had very good relations with, and we were kind of talking through kind of where we're looking, our areas of interest. And that's something I think for a lot of new investors, new multifamily investors looking to take down their first deal, I would say that's a really important point of make sure that you're as active building relationships with other sponsors that are doing it as you are with, let's say, lenders or brokers for that matter. A lot of times you can get a lot more insight from other investors. After all, they have no horse in the race. They have no, ulterior motive other than to provide information. And I think in this community there are a lot of people willing to, provide you information, help you get there. So, in having those conversations with that sponsor, he had mentioned, hey, we're looking to dispose of a couple assets here locally in Louisville. And so, if you want to make an offer, feel free. Up until then, we had just been kind of submitting LOIs to local brokers that we had built relationships with. But it's a little difficult, as anybody who's having first conversations with brokers knows, you don't really have too much credibility when you haven't taken down a deal. You don't really, it's difficult to get the time of day with brokers, especially in this market, if you don't have necessarily a track record. And so As a result, we were able to take a look at some of those assets that he had locally that he was looking to sell. We made an offer on one particular asset that we felt pretty confident about, the area, and it ended up working out.
Yeah, and then to add to that, Marc did say it did come from within our network. So, you know, building that network initially is super important because like a lot of people know, you don't know where your first deal is going to be coming from. So you really have to turn over every stone and every rock and hopefully you'll find a surprise under one of them. So for us, you know, lucky enough, we were to, you know, get this deal through our local network, and he was a sophisticated investor. So during the process, it does help out having the seller be somebody who is in real estate and knows this field. That way, the process through us was very smooth versus other stories that we've heard from other operators. And I know we've also gone through the same process also, where we tried buying something from a mom and pop, somebody what definitely was unsophisticated. And the information and the financial that would come from that would be very limited and very little information on the asset versus this one where we kind of had a lot of the information, a lot of the leases, the financials, and it really helped us out when we were underwriting the deal and really during the due diligence process.
I see. Yeah, that's an interesting point, actually, Gonzalo. And so just to clarify, like, again, like to repeat for our audience. So, you know, between, let's say, broker relationships and like direct to owner, and in this case was more of like networking with other sponsors and kind of obtaining the assets of another sponsor and kind of further improving it down the road. Is that a fair assessment? Yeah,
that's a very fair assessment.
Yeah, absolutely.
For the syndication model, as everybody knows here, you know, typically the way it works is you raise a bunch of capital up front. Some of that may end up being your CapEx budget, but once that budget is expended, any other, you know, contributions towards CapEx has to come out of cash flow. And so what you see most often is, especially in the last 5-ish years, people will go in, do their interior, exterior renovations, 2 to 3 years, they've hit their numbers, they're selling out because there may be, you know, they may have reached kind of the returns that they're looking to deliver to investors, and they're able to take some chips off the table. So that's kind of what had happened in this particular case. The sponsor had expended their CapEx budget in order to get the next level up in terms of rents or tenant quality. You know, it needed an infusion of capital, and that's kind of what we brought. So I would say that's a good thing to keep in mind too when you dispose of your assets. Is you know, you hear this all over the place, but you want to leave meat on the bone. You want to leave kind of some upside there for the next person.
Yeah, completely agree with that. And that's definitely part of our business plan with this asset that we purchased, thinking, you know, with that being said, we have that business plan where, you know, 3-4 years, we've incorporated that kind of left meat on the bone on this deal. And we're doing it in a way where we're going to be potentially renovating a couple of the units, more of a premium finish, and seeing if you can maybe hit those higher rents that we're potentially getting with more of the classic finishes that we're going with. So if we can prove of concept with those couple of units by investing a little bit more, maybe upgrading more of the kitchen, maybe brand new cabinets versus just painting cabinets, and hitting those numbers, that's definitely that meat on the bone that Marc mentioned that is proof of concept for the next investor that can see that and be like, all right, this is something I'm interested in.
So one question I have actually, like you mentioned an interesting point where, okay, you have to leave some meat on the bone, right, for the next investor, because otherwise, I mean, like assuming it's value-add investors, you know, which is to an extent the profile of, you know, this kind of mid-range syndication deals, right? So assuming they're value-add investors, you know, like you could actually render your asset unsellable if you perfectly optimize it. Would that be a fair, you know, assessment? And then the second question is, you know, what do you see in terms of, I guess, like the market cap? You know, let's say like you have the market cap in, let's say, Louisville, Kentucky. Would you say that if the deal was through an agent, because here it's like through a sponsor that you knew, right? But if the deal was through an agent, would you say they would price below or above the market cap based on this perception of meat on the bone that is there? Or is that something you don't see, or do you see kind of like fair entry cap pricing?
Yeah, so in terms of, you know, why you leave meat on the bone, I mean, it's kind of, kind of elemental to it's kind of, gets back to the principle of what we're all in business to do, which is generate returns, to after all make money. And so, if you're buying something that's been optimized already, you're going to pay that price. You're going to pay a price that corresponds to that. So, that's kind of why you want to leave a little bit of meat on the bone for the next person is, they're willing to pay somewhere in between how it's operating today versus how it's going to operate in the future. So that kind of gets to the heart of what you're asking is, how much is the right price in terms of caps? I honestly, I will be the first to say I'm not that big of a believer in cap rate as a measure. First of all, I mean, everybody has you talk to one broker, they're going to tell you it's a 10 cap, when in all reality, we all know it's going to be closer to a 5 or maybe sub 5. But that aside, cap rate is just a snapshot in time. I think one thing that's useful, it's useful as a sanity check to make sure you're not drastically overpaying. But more important than that is where can you push that cap? And I think a really good metric for that, for us as value add, is yield on cost. Actually, a concept that I first learned a couple of years ago from a guy who was on here earlier, Anthony. But yield on cost, I think, is very useful for value add investors to look at versus where the cap rate is currently.
Yeah, completely agree. I mean, you don't really overly care. It's super secondary, really, where the cap rate is. You just care kind of to lever a difference in the cap rate more. But I guess my question was, one thing I have seen, and I'm not a huge commercial investor. Obviously, I bid on a couple of things recently. And one thing that I noticed on one of them, so there was like extensive value add, but then the issue that I had with it was, okay, then the agent seems to kind of price in, kind of like put in an entry cap that's even below the market cap, because they know there's so much meat on the bone. So they kind of like price out some of the upside for you. So I was kind of like, got like slightly interested as a pretty new to the commercial side myself, I got like slightly interested in, like what's that relationship, like in terms of entry cap pricing and value add. So that was like one thing, but you make like a very good, of course, a very good point. It's a point in time snapshot. It's a point in time measure. It doesn't reflect like also a ton of other things, obviously. As for what you're going to do with the project, it doesn't reflect the upside, it doesn't reflect the, even your leverage, doesn't reflect so forth and so forth. And generally, it's not what commercial investors are even after, right?
Right.
It can be pretty much any cap, like as long as it's sufficient at the entry level, and then you can lever it. But yeah, that's like one thing that I've been kind of like this relationship, because then you want to have like an exit cap, and I feel like I always wonder, like, would an investor buy slightly below the market cap if there is an extensive upside? But then it kind of doesn't seem very rigorous to buy below the market cap and then be, given your, assuming, let's say, the same exit cap list, the entry cap. It's a little weird, it's kind of like overpay to get more upside. And that's like one thing I didn't like. It was, oh, well, agents are kind of pros. They know what they're doing. They're kind of like pricing it out. And so that's like one thing. I was curious what your take on would be,
Yeah, one thing I would say regarding the brokers offer memorandum, there's a lot of times they're really making a very rosy picture in there as far as like, especially market rents and what they think that you can hit market rents. So definitely got to look at making sure that you do a good rent comp analysis to make sure that the comps that they do put in that OM and make that cap rate amazing is actually something that you can really hit on your property. You have to compare apples to apples, and that sometimes can veer what the asking price is based on these like rosy market rents that they think that you can hit, but in reality it's really below that.
Yeah, I think absolutely. It's in the commercial space versus kind of the residential, which myself and Gonzalo come from. It's very much, I think there are very much less comparably protections in place for you as a buyer. It's kind of this caveat emptor is the prevailing sentiment, I think, where it's on you to figure out whether or not they're telling the truth. And so you just have to keep that in mind with everything that you look at. I know Gonzalo mentioned mom and pop operators. That's why, I mean, there may be an opportunity presented by a mom and pop seller, but there could just as easily be, a landmine that you have to watch out for. So when you're going through due diligence, that's something that you definitely want to, trust but verify, really everything.
So what do you mean, like, Marc? So for example, let's say, so your point is, let's say the case of a mom and pop operator where like many investors are they like it. Okay, that means it has a bigger potential to be a deal. But you made and Gonzalo made a point earlier that actually there's a question of where you may not have the right data on that property. So it's like a higher return, but then if it's scaled by like a lesser, likelihood of getting the right data, your expected return might be the same or worse, right? It's this kind of thing.
Sometimes with the mom and pop operators, you get pretty much a shoebox full of the stories, shoebox full of like receipts, and here you go, here are the expenses. So it's like sometimes you have to be detective on that side.
Yeah, I mean that's basically the due diligence process. Is you're being a detective, and true to your your title here, Finance Meets Real Estate, talking about risk reward. I mean that's really risk reward. Are you comfortable? For us on our first deal, we were more comfortable paying slightly higher price to have certainty in the financials and know what we're getting into. Because after all, we were buying it from someone like Gonzalo said, that's familiar with the syndication business, touts himself as a real estate investor, and so we could have a little bit more confidence. That being said, we still went through all the normal checks that we would with a arm's length transaction.
Makes sense. We have a question on the chat from Nelson, and actually Nelson, if you like, feel free to speak up too.
Okay, sure. Thank you, Stefan.
Always. Go ahead.
Always, thank you for having these great guests, Marc and Gonzalo. Great to see you guys. I wanted to know, we were talking about mom and pop, so it's kind of backing into my question. Is there a specific reason why you guys closed on a 37 units? Was it just an opportunity, or was it part of a big strategy? Because I'm looking that it's a fair. You guys are living in New Jersey, New York, right?
I'm in Charlotte now.
Okay, so that's still a distance from Louisville, right? Isn't it Louisville, Kentucky?
Yeah, still a flight. Yep.
Yeah.
So want to answer that, Marc?
I'm in the New York, New Jersey area, and for both of us, it's a flight. Yeah.
Okay. So any specific reason why that unit size, was it an opportunity or was it a part of a strategy?
Yeah. So great question. I think for us, honestly speaking, I think it's good enough size where we could wrap our head around it, but not so big where we felt like we were taking on more than we could kind of chew. Or however that saying goes. So I think having done that 32 unit syndication, I think that was probably the smallest. It was a roughly $2.5 million purchase. I think that's probably the smallest that we would syndicate. Maybe even probably today wouldn't pass our test as far as being big enough to syndicate. But as far as like our history, we had done stuff like I mentioned in the residential space, duplexes, triplexes, 5 unit, and so we felt we were ready to move up. But for us, 30 unit was kind of a logical progression as opposed to looking at 100, 150 unit,
Yeah, and we were actually, Nelson, our target market was really Nashville and the surrounding, MSA of Nashville. So Louisville was not too far of distance from Nashville. So when the opportunity presented itself, especially that it came, within our network, we knew that person and we trusted that person. We felt like it was, kind of like writing on the wall that this is really the first one that we should really take down and kind of put that first notch on our belt, something we can hang on the wall and show brokers and say, hey, we're real deal. We closed on the deal and, we're here to stay. And that kind of is now opening up the opportunities for us in that Louisville market now that we own this asset. And potentially, we can start acquiring other smaller stuff in that area.
Okay.
Yeah, I would.
I'm sorry, Marc. Say again, please.
Yeah, no, I would definitely, advise somebody to start off with their target market. For us, it was Nashville, but as we kind of, went down there and were bidding, deals and stuff like that, we realized how competitive that market is, and we kind of looked at within a 2-hour radius, kind of other satellite markets that were, good size and had similar fundamentals, and so Louisville was one of those.
So it's part of basically a strategy. You were in, if I understand, you were in Nashville, still at Nashville, too much cap rate compression, and then you went out. You got smart with Louisville, and then there was a relationship there, someone that you trusted, had confidence, and said, just like Gonzalo said, it's the writing on the wall.
Yeah, I mean, I will also add to that is that, Kentucky is also a very landlord-friendly state, a very business-friendly state, similar to Tennessee. So that was just another thing that we felt comfortable that it would be a good purchase in that state, similar to where the Carolinas, where I live. It's a business-friendly state, and that's really where we want to look and continue looking. Versus the Northeast, as everybody knows, it's a little bit difficult sometimes to find assets, within a reasonable price range for someone like me and Marc that are just starting out. Maybe we don't have a huge network. So coming to the Southeast, the areas Tennessee, Nashville, we felt a little more bang for the buck as far as for per unit cost over here.
Yeah, and economically speaking, I mean, that's kind of like my bread and butter. A little bit about my background. So I manage portfolios of municipal bonds, so city and state debt. And so that affords me kind of, I spend most of my day looking at local economies, and some of the same underlying fundamentals that you get in Nashville are the same that you get in Louisville, eds and meds, population in migration, and a lot of labor going there, a lot of employment going there. So it kind of just fits with the thesis of we want to invest where our capital goes the furthest and is the most appreciated.
So since we're talking about that in local government, what are you guys' thoughts on Memphis? I mean, that's in Tennessee. That's within 2 hours of Nashville. What are you guys' thoughts on Memphis?
Yeah, so I don't have the data in front of me on that, but what I remember, I mean, obviously across the board last year, rents pretty much, did really well, excluding some of the gateway markets like San Francisco, San Jose, and New York. But Memphis was right up there, I mean, in terms of rent growth. So it's not a market that we've looked at. Frankly, a lot of the people that look in Middle Tennessee, for whatever reason, they kind of shy away from Memphis. I think it has a certain stigma, but that may present opportunity as well. And so I wouldn't shy away from Memphis just for that reason. I would just want to be really certain about submarkets, just like anywhere. I mean, you invest in cities, but you invest really in neighborhoods. And so you want to make sure within Memphis that you're investing in the right neighborhoods.
Yeah, and I would definitely add that, every market has opportunity in it. You just have to, know your market, know your neighborhood. It's real estate is so local to where you are that it's, there's opportunity everywhere as long as you really focus and you know the neighborhood, the rents and things like that.
Okay. And Gonzalo, because I said Memphis and this huge smile came on your face, like, I'm pulling my wallet in my front pocket or something.
Are you, if you're an investor there, Nelson?
No, I'm just curious. Actually, I have
okay.
My brother lives in Memphis, so I was just curious. Whenever I say Memphis, I get this, the eyes get big and stuff.
No reason.
Yeah, I think a lot of them.
Florida, actually. Yeah, right, Nelson?
Yeah, I'm in South Florida.
Yeah.
I feel like in some ways Memphis is like the redheaded stepchild of Tennessee, large cities. So you hear a lot about Nashville, a lot about Knoxville, Chattanooga even, but Memphis, I don't know, for whatever reason, it goes a little bit unloved. It's kind of like the Detroit of the South, I guess.
Yeah. Oh, I like that, the Detroit of the South.
So you mentioned, you guys mentioned real estate being kind of local and neighborhood based and that. So what do you do in terms of your, let's say, because your target market was Nashville, right? So let's say if you want to share for our audience, some of the work you did in terms of neighborhoods and prospecting and parameters that you look at and things like that, that you were looking at in that market, and then specifically now as well, as you're moving on to, future deals, what are some of the things you look at in terms of markets?
So in terms of when we're looking at a market, obviously if we're out of state, one of the first things that we always try to do is see who within our network invests there and has invested there. Oftentimes, as I mentioned earlier, they're the richest source of information that you can get, because you can learn a ton, online. Don't get me wrong, there are tons of websites, bestplaces.net, Data.io, USA, and all these websites that can give you one picture, but there's nothing like knowing somebody that invests there or having family there and getting that local market insight. Beyond that, I would absolutely recommend going there. Again, it's one thing to look from afar at a market, but going there, walking the streets, talking to Uber drivers, local business owners. I mean, just be a sponge when you're there, talking to brokers, obviously. And as well, that showing face to brokers will go a long way, in terms of showing that you're a real person. You're not just an out-of-state investor wannabe kind of wasting their time. And so I would recommend when you're looking at an out-of-state market, get there and build up your network locally.
Yep, everything Marc said, that's beautiful.
So kind of like the personal side, kind of like get to know people, like
Yeah.
submerge yourself into it, right? Like and understand it like that from inside.
Know every neighborhood.
Yeah,
When
sure.
you're there, we drove around pretty much the entire city, and
Uh-huh.
even on the outskirts of the city. And while we were driving, whoever was driving, they were obviously concentrating on driving, and the other person was whipping out Google Maps. And on my maps, we built a database for each city that we have a target market in, and we would outline each location we would drive through, and also take note of kind of the neighborhood, perhaps even note the growth of progress, where everything is kind of going out to, and note that on there. That way, when you gather this information, it's on there. You go back home, you tend to forget this stuff, but if you open up the My Maps, you can then see, okay, when deals come in, where in those neighborhoods that you drove through, those deals fall. That way we can kind of, have a good understanding of where that property is. Is a C-class property in the B neighborhood? Is it a B property in a C neighborhood? So that was important for us also, is to identify, each neighborhood while we were down there.
Yeah, we use, as much as like you were mentioning, like, get the human side. We look at a lot of data too, don't get me wrong. But in addition to the data, it's kind of like forming a mosaic, right? You want to have those conversations with people. And then there's these tools that Gonzalo mentioned, like My Maps. We also use Google Alerts to find out what's going on locally. So we'll set up Google Alerts for those particular areas. That's a tool that we were given by a past mentor of ours, and it's been tremendously useful. So we'll bring up development projects that are going on. We'll pull that up on My Maps for articles that we've read when we're on the phone with brokers, and that'll blow them away. The fact that we know just as much of what's going on in their local market as they may.
So Google Awards would give you, like, Mark, what are some examples, like, for our audience, like, of items that you can kind of be awarded about within a neighborhood, let's say?
Yeah, so you can pretty much set up any kind of phrasing, and it'll provide you, timely updates on news articles that meet those phrases. So, for example, I think we have them set up for, let's say a part of Nashville. Let's say Smyrna development, or Smyrna local economy, or Columbia, Tennessee, jobs. And so you'll get any article for that particular area to your inbox, whether daily or weekly. You can read that stuff, and you can get just as much information as somebody there might have, or if not more.
Yeah, which is really great, because that's a great point. It's otherwise, as an out-of-state investor, it's harder to really submerge yourself in that place, right? Because your social media is geared to your actual physical location and so on and so forth. So, right. And so Cedric is asking, so Mark, you mentioned yield on cost. Can you expound on that a little more?
Yeah, Cedric, great question. So yield on cost is basically, it's what they use in construction development. So it's a metric that is used in that realm, and for whatever reason hasn't been adopted as widely, I think. Some people use it in multifamily, but basically allows you to look at what is the equivalent of kind of like a cap rate, but for a value add deal. So for example, the way it's computed is NOI, stabilized NOI. So it's not the in-place NOI, it's stabilized NOI in 2-3 years, whatever your business plan is, over purchase price plus CapEx, plus your renovation budget, basically. And what that'll tell you is, let's just say that a prevailing market cap rate is 5% in a given market. And then you run yield on cost and you see, oh, that's 5% as well. So basically, by you taking on this heavy value add, you did some kind of work because there's a CapEx budget, you're getting no better than the market return. So in that case, you might as well just invest in a stabilized deal and call it a day. It's less work, right? And so that's kind of the use of yield on cost. You want it to be higher than the prevailing cap rate. And as far as a measure of how much higher, that's up to you as an individual investor. I want to see 1%, at least 1% higher. So if, in our markets, 5-6%, I want to see 6 to 7% on the yield to cost on a value add deal, to know that the money that we're putting into the property is worth it, basically.
Yeah, and then just to add to that, like if a project is definitely value add, that means it's pretty construction heavy in the construction side. So there's a lot of unknown risks that are going to come from that, and that it's really hard to measure that stuff. So anytime you do go into a value add, just realize that in any construction project that you kind of overtake, there are going to be problems and issues that you're going to have to deal with, and that presents definitely a risk that you're going to have to put some sort of number on it. So that really helps also giving you a gauge on that.
Yeah, you want to be compensated for that risk. I mean, back to the whole risk reward thing. You
Right.
want to, knowing that you're taking that risk, you want to be compensated as an investor.
All right, thank you. Because I've never heard of yield to cost. So that yield on cost, I should say. So that'll help me out a lot. I appreciate that.
Great. Yeah, awesome.
So, I mean, so sort of like yield on cost relative to, let's say, the market cap that you have is a little bit of guide, let's say, for US for kind of your value add that you have in a way, right? I mean, it's not like a perfect one because, you know, the exit cap will be different from the yield on cost in that sense and so forth, but it's kind of like you're saying, let's say you like yield on cost based on that, it's based on that, sort of like based on its, you know, let's say like its relationship to the market cap and kind of like being, let's say, X% above the market cap and kind of using that as a proxy for how much of a value add is there on that deal.
Exactly. And
fair?
value, yeah, that's accurate. I think
Yeah.
value add sometimes has a lot of different meanings to a lot of different people. I mean, value add, like Gonzalo and like we use kind of colloquially is, you know, you're going in, you're doing some construction, but it could very well be that it's just undermanaged. You know, by you going in and installing a third-party management, professional third-party management, you know, that's value add because you're able to, you know, take on some, you know, create some increase in valuation. So yeah, that's important. But as far as the point on, you know, yield on cost, I don't think any of these metrics is an end all be all. So I know that when we look at deals, we're looking at the story. I mean, the numbers tell one thing, and that's great. But I mean, look at any of these numbers, aside from maybe cash on cash, IRR. I mean, that's just chock full of assumptions. And what do any of us know what the market or the world's going to look like in 2-3 years? And so does the story make sense? I think that has to be the primary question that you as an investor answer.
Mm-hmm. Yeah, I mean, IRR. So what do you think? I know, Marc, you listened before to Ryan, right? And his lecture on like, he does like lectures on like IRR is not your friend. So like, what are your thoughts on that? Like, just curious.
He's cornered the market on hatred for IRR.
Yeah, sure.
As a finance guy, I mean, I like IRR because it kind of summarizes everything into one metric. But as a human being, I also understand that it's, like I said, it's fraught with assumptions. So you just have to be really careful with it.
Yeah, I mean, it's kind of because it reflects timing, but by reflecting timing, like in the real world, you could be indifferent to some of that timing, right? Much like such as within a 6 months period and so forth. But then it so heavily is going to reflect the time, which is even going to give you like a crazy higher return just because you shifted things by several months. And it may be a different dynamic in the real world or for your investors and so forth that they don't actually value that so much. And you know, there's like this kind of perspective too. And
yeah, if you ever want to like, you know,
pulling an earlier refinance and whatever. You know,
yeah, no, absolutely. It's we're going to geek out on this stuff, but if you ever want like a masterclass on these return metrics and things like that, in my opinion, there's nobody better than Rob Beardsley at this stuff, talking about this stuff. He's like, you know, kind of an authority on talking about all the different ways to look at a deal numerically. And so he's got some really good content on that.
Yeah, I met with him in Manhattan last week with Rob, actually. he's a cool guy. He's a smart guy. Yeah, I like him. So
yeah, what's the Buffett quote about being aware of people bringing higher maths or whatever the case may be? Beware of anybody who quotes too much higher math, you know, IRR and cash on cash and all this stuff. Like I said, it has to make sense.
Yeah. Rob is an underwriting guru, underwriting expert. That's his favorite topic. That's cool. And yeah, so let me see if we have another question. So yeah, Nelson is asking. So I will forward you his contact, Nelson. He's on LinkedIn. You can just look him up. He has a book on underwriting that came out a while ago. Yeah, exactly. Yep.
Yeah, he could probably explain this stuff much better than I could.
I had him as a guest back in like a while ago. Can send you the link. No worries. So yeah, so that's interesting. Yeah, those are like very good comments. Is there like, do you guys want to talk about, let's say, like where you are now, like what are you looking for now? And let's say I'd be curious in terms of like your approach to looking for deals, right? Have you totally given up, let's say, on direct to owner, or it's like only agent relationships, or do you do any direct to owner kind of like, like prospect now feeds or reonomy feeds and like mailing people? Is that something you guys do? Do you see it like others to do it at all, or it's just like everybody does?
We've seen some luck on other operators that have found deals on direct to owners. I mean, we're testing the waters on that stuff. Kind of, we have a list that we bought for our certain areas, and we have one of our partners that kind of is calling the list and seeing if we can find something there. But typically, the day-to-day for me is really just calling as many brokers as I can, right? And then networking with people, property managers, specifically property managers, anybody really, and they can refer you to a person that's looking for a deal or has a deal and maybe it's near you. So then you reach out to that person. It's like a spider web, and at the end, it can potentially garner you a nice deal, that you're then looking at and closing on. So really, for our strategy is really to hit definitely the brokers and really just network as much as possible with anybody, even if we go as a co-GP with somebody, maybe assisting him on a deal, bringing in our certain our expertise on at least this one deal that we closed on. So
makes sense.
I think it's still evolving. I guess TBD would be the short answer as far as acquisition stuff. But yeah, with Gonzalo doing this full time now, more recently, he's able to kind of nurture those broker relationships, and then as well as all the other relationships that he mentioned. We were talking to a property manager today who said, if they come across anything, they'll definitely let us know. So you just, to his point earlier, you never know where a deal's going to come from. So you just constantly have to be shaking the tree. And, it all goes back to, again, like the first thing I said was like network.
So let's say, like we've had like some of this discussion, but let's say like a residential versus commercial, like you mentioned some of it a little bit at the beginning, like the argument for you guys moving on to commercial, it's like the efficiencies, kind of having a property manager, being able to scale in a way that's not like a crazy operational hassle, like this kind of perspective more, or is it more the perspective of, well, let's say equity gain in the residential space, it's on a relative basis more renovation based?
Gonzalo, do you want to go into the economies of scale, and maybe I'll go into forced appreciation?
As far as commercial real estate is related, yeah. So the coming from the smaller side of things, which we still own a couple of small properties up in Newark, New Jersey. So we're it's sometimes it can be, because we manage that with obviously some contractors that are local to the area, but it's definitely more hands-on when issues arise versus this the 32 unit in Louisville. Right now definitely is a little bit more hands-on deck, especially when it's coming is related to the construction side of it, because I'm dealing a lot with that in a day-to-day. But once that gets stabilized, it's pretty much going to be on autopilot. We just have to attend weekly calls with the property manager, review some task work orders that they issue, approve a couple of things here and there. That's our goal eventually in like 18 months. But right now it is a little bit intensive. But the point is that having that property manager handle all of these things, because we're not local, it's great. And also the vacancy is another issue, that if you have a couple of tenants, obviously you've heard it, that are not in the unit paying rent, it's not going to really affect you as much as if you own like a triplex or a quad, when maybe one or two people move out. That's really going to affect the bottom line on that property.
Yeah, I mean, it's a team sport. That's why we got into it, is because we can outsource the stuff that we're not great at. It's not, frankly, I don't think either of our gifts to the world, our ability to create a lease or show a unit. Better leave that to the professionals, and we can focus on the more kind of higher dollar per effort tasks, like finding deals, building relationships with brokers, and so on, raising capital. The other side of it too is kind of what you mentioned, Stefan, is forced appreciation. You don't get that in the smaller multifamily, 4 units and in, basically. So the fact that if you increase rents, it'll have an outsized, and not just rents, if you really do anything that improves NOI, it'll have an outsized effect on valuation. I mean, $50 to the NOI on a commercial property is way different in terms of wealth generation than it is, on a duplex that we have in Newark. That's just an extra $50 a month.
Yeah, especially how cap rates are so compressed nowadays. Any small improvement that you do really like hits that value of the property. I mean, it just like skyrockets with these crazy cap rates are happening now in like local markets. So, you know.
Yeah, I saw on LinkedIn, like, I mean, actually, because you're now in Charlotte, right, Gonzalo? You said, or
Yeah, I originally New Jersey and moved down here about 8 months ago to the
yeah,
Carolinas.
I understand, but I mean, right now, and let's say there was so one of those deals was in Charlotte, and then like a couple, like probably one in Florida. There were like a few deals on LinkedIn recently that had like super fast exits on the syndication side that had like 12 to 24 month exits on
Wow.
like a pretty high equity multiple.
Yeah,
You know, like,
I see these too. I see these too where
you
it's
might
like
have seen,
just
I'm sure I've seen some of them. Yeah.
Yeah, that's the market we're in right now, that some people can buy these things and flip them in like 12 months, you know, it's crazy.
Yeah, like kind of like in the comments, you know, people were asking, okay, so what's the driver of that? And kind of like the primary explanation was cap rate compression. It wasn't so much even like the actual force, the actual work, you know, there wasn't even so much.
I think it's a combination of cap rate compression and definitely the fast increase of rents. That's driving
the
a
rent
lot of that.
index, exactly, absolutely, yeah, exactly. Yep, but I mean, they did have, all of those projects, they did have good value add as well, but it seems like, you know, the market side really accelerated too. So, I mean, we know what, I mean, it's like in Phoenix, like it's rent growth over above, what is it, above 20% or something?
Double digits, it's insane, yeah.
Or is it just above 10? I thought it was actually 20.
Yeah, no, it's 20 plus. Yeah. I mean,
Yeah, right.
when you have a national average at 18, you know, 25 doesn't look so ridiculous.
Yeah, it's pretty crazy. Anyways, yes, do you guys have any other questions if you want to speak up?
Yeah, if you don't mind me asking, I'm kind of in the process of trying to get in the GP side of syndications. But I don't really know who else does it, so I'm just like networking all day, every day. And so if I missed this, I apologize, but how did you, Marc and Gonzalo, sort of link up and get started as a team? And how many other people are on the GP of the 36 unit you guys just picked up?
You want to take that?
Yeah. So we linked up initially back in 2017-ish range when we were both doing stuff in the residential space. Gonzalo flipping and myself doing much smaller, basically condos in northern New Jersey. We actually, sounds funny, but we met online at Bigger Pockets, basically. And so we had seen that we're both local investors, got out for a beer and kind of had a lot of the same vision, wanting to, you know, supplement our W-2 income at the time and, you know, take our investing to the next level. And so we started off very, very small, doing duplex, small multifamily, and then a lot of bumps and bruises along the way, and kind of saw what each other was kind of made of in terms of when times got tough, what type of individual, you know, that other person was. And so that built the trust, that built the just, you know, being able to rely on someone else. And also the other fact that I think for anybody looking for a partner, look for somebody, I'm not the first to say this, but look for somebody who has what you don't have. So, you know, Gonzalo with the ability to talk the construction talk and the CapEx and manage contractors and, you know, even frankly, draw up structural drawings. I'm, you know, lost if you hand me a hammer. So I kind of bring the financial analytics and that whole side of it. So it was just kind of finding the right person that has a skill set to fit my weaknesses. And
then I think the second part of your question was about partnering with other people. So yeah, like for this 32 unit that we closed down, we definitely partnered with 4 other people. 2 of those people helped us raise some additional capital that we were lacking in the raise. And then the other 2 were able to really come on board as more of a the other side of the GP to bring in the agency experience because we did have to sign a Freddie SBL loan on this, and just with Marc and I alone, we would not be able to apply for that. So I would recommend definitely is a network, and then make sure you find partners that have, you know, own a property already and maybe have that agency debt on their resume. So that way you can team up with them, give up some of the equity, which is fine, and then eventually, you know, you would then that experience would transfer onto you, and hopefully on the next ones we'll be able to be the same person, the same as the people that we partnered with in order to do that. So
And Nelson, that was a Freddie Mac SBL, a small business or small balance loan, sorry. I forget exactly the parameters as far as loan size. I think it might be below 5 million or 6 million or so principal. And so it kind of fits in there in that box for them.
Okay, all right, thank you. I just wasn't sure about the SB and getting the rest. Thank you.
How much
Yeah.
time did it take to close, Mark, for them? Let's say, I mean, was it like a 90-day or?
No, it was 30 days due diligence, 30 days. We had to exercise an extension because unfortunately the lender didn't get things done in time, but it was probably 35-ish days to close once we had the due diligence done.
So in total, from the initial
65, 70 days.
65, 70 in total. Yeah, okay,
Yeah.
got it. Good. Yeah, that's not bad. That's on the quicker side, I guess, for commercial. Have you considered like some of those, you know, a couple of people on this webinar, they quote deals with, you know, like asset-based lenders have expanded into the commercial space, like Lima One Capital do like loans up to 20 million and stuff like that. I mean, the rates could be slightly higher, a bit higher, but have you considered that in terms of like fast closings and things like that, or?
Yeah, Jake and Gino have a really good kind of framework for their syndication business where what do they say? Buy right, finance right, manage right. And I think that finance right one is one that often gets overlooked. And I think that's kind of another thing that I would be doing up front, in addition to talking to investors and kind of building awareness that, you know, you're going to be coming to them with an opportunity sometime soon. I think just like you should always be capital raising, I think you should always be talking to lenders. The loan and rate markets are constantly changing. So you should always be, I mean, I don't think a week goes by where I don't have like 2 calls with lenders, whether it be local banks or, you know, bridge debt lenders or our broker that we used on this deal. And I think having that awareness of what type of products are out there for what type of deals you may come across is going to be necessary. To give you, I guess, a quick example of what not to do, on our first deal that we were first looking to syndicate, Gonzalo, do you remember this, with the local bank in Pennsylvania?
Yes, how could I forget?
Yeah, so we had a process where basically I was a local lender. They weren't used to syndications. They were a little bit iffy on the deal itself. It was mixed use. And, you know, it was like every week we would get a different excuse as to why the loan committee wasn't comfortable with this risk. And then they would go back and, you know, make the case again. And I think that's why it's really important to just make sure you have the right lender for the right deal.
Yeah, that's a great point. I mean, you're also kind of, you know, it factors into your return, right? Kind of like cap rate, interest rate spread to an extent. To an extent is important. So you do want to be kind of rigorous and not to overpay on the financing as well. And that, but you guys mentioned capital raising. So what is your, let's say, current approach? I know some people say like it's hard to capital raise through email list and so forth. And then obviously others have been wildly successful at it. So is it more like family and friends, or like kind of growing your email list and or other approaches, or SEO perhaps? Because there's been, I had somebody here who was like really happy with basically bringing like most investors through SEO rather than social media and other places.
Yeah, that's a great question. So in the beginning, you know, as we mentioned, we started this, you know, 2 years ago, right? And from when we started that, kind of getting familiar with the commercial real estate side of it, we realized how important capital raising was, because we went to these meetups and we met a lot of these people. So even back then, we really started sharing exactly what we were planning on doing with friends, family, posting on social media and stuff, even back then, right? So fast forward 2 years, last August, when we were, you know, June, July, when we started really reaching back out to these people that have been in our newsletter and been following us for the last, you know, 1.5 to 2 years, we started that conversation where, you know, we have this deal and they've been in our newsletter for quite a while now. And that really primed the pump that previous 1.5 years, and what allowed us to really raise the, you know, the majority of the money needed for this deal from mostly friends and family, really, this first deal. And we then teamed up with partners to kind of help us kind of meet that gap and meet that rest of the way there in order to close in this deal. Now, moving forward, I think that we're still going to continue on that path, but I think we're going to maybe shift a little more with bringing on partners that can help us raise the majority of that capital, because we're like so focused right now on searching for deals, underwriting deals, and developing broker relationships that we feel like capital raising is really like an expertise on its own that people can bring to the table for us.
Yeah, and another thing we're doing is we're hiring a kind of marketing company to help us vamp up, this whole thing. So it's more, I would say, not passive, but it's a little bit more less intensive in terms of our time, so that we can have a lot of automation in place. Like people get with Active Campaign and a lot of these other systems. I think I remember Neil Bawa, or maybe it was Michael Blanc, presenting on the fact that he basically wakes up and his calendar is full of calls with investors. And that's kind of like the end state. That's like what you want to get to. But, getting there is, it's stepwise. You're not going to get there overnight. And so I think we're still very much figuring that out. The one thing, though, that Gonzalo mentioned there that I think is really key for anybody starting off in syndication is the process starts very early on. I think it would be ridiculous to think that you find the right deal and the money will come. I haven't seen that working personally. I've seen a lot more the opposite being the case, where people have these deals under contract and they don't know how they're going to fund them. And so I would say all of that legwork that we did up front, leading up to this, built our brand, built our credibility to say, okay, we know what Marc and Gonzalo are about, that they've been looking at deals for a while, and this is finally an opportunity that like they've been telling us about.
Right. Yeah, that makes sense. And so in this process, since you mentioned kind of you guys were, you've been doing this for some time at this point, like kind of like searching and like landing your first deal and, like looking for other deals now, etc. So what would you say are, like some of your big pieces of advice, I guess, to people, or let's say not advice, but there are other things that you learned, which were like, insightful and kind of like inspired you. And I know forced appreciation is one. That's obviously something, you come from the residential space, one kind of learn, so well, that's a wealth building too. You can kind of a little bit more streamlined wealth building than in the residential space. And so I know that's one thing that has inspired you. And what would you say are some others?
Yeah. So in terms of things that inspired us about multifamily, you're saying, or about syndication?
Yeah, I mean, within the multifamily syndication space, for sure, but kind of like things you learned over these 2 years that are kind of like big, kind of like aha moments, or like things like that actually, have helped you a lot.
Yeah, I would say for me, it comes down to like there's a book, Who Not How. I think that title kind of says it all. Is like you're not going to know everything. Frankly, I think both of us, myself and Gonzalo, are very analytical. I think the mistake that very analytical people sometimes make is that they have to have all the information before they make a decision. And you're just not going to have that with multifamily, with large syndications. At some point, the rubber has to meet the road. You got to make a decision and decide to move forward. Your first deal is not going to make you rich. Hopefully it doesn't bankrupt you either. So you want to, don't get me wrong. I mean, take all the, be prudent in your education and everything like that. But at the end of the day, you have to make a decision and stand by that. The other thing is networking, not just, I would say networking, not just when you're looking for deals, but networking more generally. A lot of the people that we have built relationships with over the course of the last 2, 3, sometimes 5 years are the same people that we leaned on when we had questions throughout the acquisition process. So, I remember a few conversations where we reached out to individuals that, they ultimately gave us the insight that would have taken us probably days to get if we would have even gotten them on our own. And so, back to what I was saying, the who, not how, I think you don't have to know everything. It's just important that you have access to people that do.
That's a great point there. And I mean, I guess you kind of slightly alluded at the beginning of your your statement that, okay, in the commercial space, it's, and I haven't read the Who Not How book, actually. I've heard of it, but I haven't read it myself, though, like you kind of alluded to, okay, the relationship side of the commercial real estate industry, right? And like, I feel like there's kind of a counter relation between, how people base it is obvious and how much data is there. And so the CRE industry is not so data-based, it's like very much relationship. It's very much like, well, knowing agents and so forth. But on the contrary, like to your point, like to an analytical person, it becomes a little bit challenging that, okay, now you have to actually just be on the phone with agents all the time. And that's the only thing that's building your business forward. Because, you know, like I mentioned, I met with Rob last week because you mentioned Rob before. And so he was, so meet with him, okay, let's talk like some analytics, you know? And, you know, like, I feel like he was like, man, I'm like, he's like on the phone, you know, with brokers. Like, I'm just like, it's like, because I always like, we have like exchanges on LinkedIn, you know, like about these kind of things. And like, I always think of, okay, like so analytical, but then now on a day-to-day basis, okay, I'm actually, you know, gonna just like talk to broker. I don't care about any of this.
And he has to pick up the phone call, right? Because there might be a deal there waiting for on the other line if he has a broker on there, right?
Yeah. I mean, yeah, it was just like, you know, which I understand. It's so tricky in this industry, and like, yeah, and like, what do you use actually any stuff? And no, not really. It's like mainly agents, you know. That's how it works. So it's like, it's very, very tricky.
Yeah, it's not an efficient market, as we in the financial markets, I guess, world would say.
Yeah.
And I don't think that'll change anytime soon, by the way.
No,
There's a
yeah,
lot of talk about blockchain and tokenization. I mean, that could be a step in that direction, but I think that'll be probably, you know, decades before that's widely adopted, where, you know, these things can trade more liquid in a more liquid fashion.
Right. So you mentioned, so what do you guys think indeed would be the big kind of technology developments? Because I mean, like, if we look at, like, I find it interesting, like some of the investment, like by venture capital firms, so they would invest in things like Picasso for second homes, and, you know, like that, those are like companies like that have like the super high funding rounds. And then what actually appears to, you know, like us technology laymen, kind of what appears to us is like the very breakthrough technologies, you know, like the tokenization, blockchain, or other things, have like minute investment. It's crazy. Like, if you look at blockchain, people didn't invest anything, you know, because I'm Eastern European, I'm Bulgarian actually. It's like one of the companies like led by a Bulgarian lady, Natalia is her name, and that's Propi. So that's kind of like the biggest blockchain startup in the real estate industry, and it had like some kind of media coverage where what's the name of the guy? I forget, like a famous VC guy invested in her startup, but the guy invested like $1 million. He's a billionaire. It's like
Andreessen or Horowitz, yeah.
Sorry,
Andreessen, is it with or Peter Thiel?
no, it's I forget now. I forget now his name, but no, not like the Andreessen like VC fund, but second, no, Tim Draper. Okay. So he invested in Propi, and that's like the biggest blockchain thing in the industry. Okay, but he invested like $1 million, and he's a billionaire. You know, it's like funny. So it's like basically close to minute, like no investment whatsoever at this point, which is quite interesting. So they don't recognize it as an opportunity, because they have like, and somebody I know runs like one of the tokenization companies, Reino, also a Bulgarian guy, by the way. And so he is like, Reino is like tokenization company. And so he, you know, like they obviously see it as an opportunity, and there's like companies like Solid Block and you know, DigiShares and so forth. We have some of them on this webinar, but then it's not what the professional investors are recognizing, it seems. So it's quite interesting. It's definitely very, very early. And even something like Propi, which has due to because they're actually improving the closing process kind of with blockchain. So it's kind of a more value-add task, not just, oh, let's tokenize something, right? What does it mean tokens? It's nothing, right? You just write a contract on the blockchain, publish it out, and you hire attorneys, right? That's the whole thing. So it's like not really a very big technology thing. But then let's say Propi, okay, they improve the closing process. But even that, you know, like I've been looking at like their token value, and they've been around for like maybe 4 years or so, and it's like, it's not like peaking up in any way so far. So it's like extremely early, and it's quite interesting indeed, like what technologies would be the next big ones. And then if one looks at something like machine learning, so okay, then machine learning, fine, you have I don't know, like improvements in like automated underwriting is the one application, right? And then AVM, like automated valuation models, right? And pretty much that's it, mostly. And so, but then in the end, like it seems like not like huge, you know, like most investors, they just don't care because there's like so much alpha in the real estate market. And just kind of like putting like my perspective, there's like so much alpha that like all investors, they're just chasing alpha. They don't need technology. It's like the opposite of finance, right? In finance, you have minute alpha, you need so much technology to grow your stuff, to be doing like high frequency trading or whatever. And in real estate, you need none of it. because you just have like minute, you have huge alpha anyways. Everybody's chasing that. It's like, oh, who cares about technology?
Yeah,
Let's just kind of slam on iBuyers, or something.
Yeah. Nelson put it perfectly. The inefficiencies in the real estate market is what makes it profitable to us, and I thought that was pretty good. But as a construction guy, as somebody who likes seeing something built, on a construction side of things, I really think like the next kind of phase that we're going to be going toward is that as more and more money starts going into research and development for construction and means and methods and trying to get that price per door reduced, because right now the price of construction is just astronomical to build, affordable housing, right? Which is a huge short supply in this country. It's things like modular construction, where these things get built in a large factory, which I follow a company who's building these large factories, and they can pump out sections of these buildings that literally can be trucked to the site and just build like Lego blocks and substantially reduce the cost of construction and also the duration of construction. So as those things start to improve and efficiencies in that side of thing, I really think that the cost to build like larger multifamily units, which were in short supply in this country, it's going to really affect like the whole real estate field when it comes to commercial multifamily. So, it still remains to be seen in what direction that goes.
Yeah, I think there's a lot of headwinds. I actually worked for Katera. I don't know if you heard of them.
Yeah.
I worked there for like 3 years, and I was like in the trenches on some of these projects, and it's tough. Every jurisdiction has their own
Yes.
modifications to the building code, and just like, oh man, it was a crazy experience working for a company that really took a stab at doing that. I totally agree that we're going to get there at some point, but it is just it's mind-blowing how many variables there are and how hard it is to kind of automate a lot of that stuff. It's like some of those inefficiencies are just brutal.
And I think one of the questions, the same question I asked one of the panelists at an event I was at in a couple of weeks back, was related to modular construction, having things built inside a factory where it's climate controlled and everything's quality control, everything, right? So you can ship it out. And they mentioned the same thing. They're like, right now we're just not there yet, with that.
Yeah, it's tough because we had this idea of building like a bathroom, right? That could be shipped in like a box and unpacked and basically built on the spot for these exacting dimensions. But like every jurisdiction needs a little bit more space between the center of the toilet and the wall to the side, or a little more space for a wheelchair. Yeah. And it was just like, you wind up having like 32 versions of it, you know what I mean? And then you deliver them all to one site and you find out they just amended the code, you know what I mean? It's
very inefficient.
Like, brutal, and yeah, it's tough.
Nothing about local government lends itself to, rapid-paced technological change. So, unfortunately,
it's hard.
Yeah, I think a lot of these technologies are exciting. I think I'm not the first to say this, and I know Gonzalo and I agree on this. This is a competitive market. I think for the next 10 years or so, the foreseeable future, let's say, it's going to be the time of the operator, the person who can be more creative in their ability to take down deals and see what isn't there yet. And so I think all of these impending technological changes, it's really imperative that we're all aware of what's going on. I mean, Gonzalo and I spoke today with a property manager about Amazon, delivery boxes. I forget exactly what they're called, but that's becoming pretty much commonplace for C assets, B assets, and so whereas at one time it was strictly, a kind of a luxury item. So I think you're going to see a lot more adoption across the quality spectrum in terms of these technologies.
Nelson is asking actually. Oh, you go ahead, Nelson. Yeah.
Thank you, Stefan.
Yeah,
question for Marc, Gonzalo, and anyone else here. You mentioned about the Lego blocks, right? That we can now build properties like a Lego block, and it's easier to build. What's going to happen with the lower C assets that were built, let's say in the 60s and 70s? Those older properties. What do you think is going to happen with that as we go forward?
I think, I'm sure Skylar could also chime in since he's been in the modular business more than I have. But the C-class asset, I guess the asset that we acquire could be considered a C+ asset, 1980s. You know, a little bit of deferred maintenance. That's going to stay the way it is. You know, you do your upgrades, you maintain the building, you add a little bit of technology here and there. The Lego block type construction, the modular stuff that eventually someday it'll get to a point where you can ship in. I think that's going to affect pricing in some way, because my hope is that to try to get construction costs down, because right now it's just so expensive to build these things that it's the economics just doesn't make sense when you try to talk about affordable housing for people making under 40,000 a year, right? They can only afford so much rent, but yet the construction cost is so high to build these things. Is like the financial numbers, from what I understand, it just doesn't make sense to be charging $700 a month for a 2-bedroom apartment because of the cost to build these things. So there's a lot of discussions around, surrounding these things for sure.
That's one of the reasons, by the way, I think we kind of have a pretty high barrier or pretty high moat as multifamily investors, specifically focused on the B and C asset class, because they're not making any more of this product. Yeah, it does have its risks. I mean, a lot of this stuff is coming end of life, or if it hasn't already passed end of life. But the cost to rebuild, the replacement cost is, it just makes sense to buy this stuff that they're not making any more of.
And we're a bit over time, but what are your views on inflation? So are you, do you like it? Is it good for real estate really, or are there some hidden effects there that we're not considering potentially? Like, what is your perspective?
So full disclosure, neither of us are economists. That's the first thing we'll put out there.
And even economists don't seem to know.
But just as investors, just for your perspective.
And even economists, right?
Yeah.
I
would say that just based on what I learned at the great conference I went to that had a lot of people a lot smarter than I am to study this stuff, is that really your dollar has been on a slow decline since the 60s. It has lost 70% of its value. So owning assets, owning commercial real estate, hard assets is definitely a great hedge against inflation. So that's what we're all here in the business of, is acquiring as much of this stuff as possible, because we know the dollar is just losing its value year in, year out, with inflation in the single digits, and some would even say inflation is the double digits right now.
I think too, it's really important to look at, because inflation is composed of a number of different things, right? Housing is a big part of that, and so you have to ask yourself, like, what is the underlying trend there? I think, for me, again, I'm not an economist. Skylar, you brought up a good point that even some economists, most economists don't have a crystal ball. So, anyway, inflation. I mean, if wage inflation persists, if let's say that middle income, our renters, basically our tenant base, continues to see their salaries increase, I mean, you would say all else equal, that's a good thing. But then the opposite, the knock-on effect of that is, okay, if the cost of all goods go up, rates likely to go up because the Fed has to tame inflation. And so it's going to make it more expensive for us to buy this stuff. So I think there's a lot to that inflation question, a lot more than I think maybe a lot of people appreciate. And so I don't think you can look at inflation on its own in a vacuum. One thing that I'm really interested in this country is since COVID, you've seen a real kind of divergent or maybe bifurcation of the outcomes of kind of a particular group of people and then another group of people. And so you've seen a lot of people really suffer in terms of, the participation rate is very low, wages are stagnant still. So then you've seen other kind of white collar type, I'll say middle to middle upper income people do tremendously well in terms of their saving rates, and asset values have gone up. So they've got more equity in their house. And so I'm interested to see how that plays out in the economy versus maybe just, inflation.
I guess it's not a surprise that, if a government dumps $5 trillion into the local economy, that, you are going to see results that we're kind of seeing right now, is this type of inflation on energy, goods, even housing for sure.
Mm-hmm. Yeah, and Marc, you made a great point that, okay, it's kind of more like the interplay of like all the different pieces and that. When like I listened to like a lecture by my undergrad economics professor on inflation. So like some of the points that were there, so one was Okay, so one was, like there by various measures, by virtue of, what is it like? I forget all the pieces, but there's like, one is there like substitution effect that is being done. Then there's like whether housing is included, it's not included in like CPI and so forth. And between all those effects, like his estimate for, like the posted number for inflation versus the real one, like what should be the relationship of that, right? That's like the question that everybody wonders. So he is like based on like very somewhat rationed, like stuff was 3x, so that's a 6.5 versus 20. I don't know if it's 3, maybe it's, might be 2, maybe, I don't know, but that was kind of like there, the one thing. And then the other thing is that is interesting. It's like people tend to think like during inflation, okay, like you have like assets increasing and in value and, like, and of course, like you made a point, like Marc, it depends like also versus wages, like what are the whole relationship between like all those different types of inflation, let's say, right? But then, like I feel there's always some kind of expectation where people think, okay, we're, let's say if you get like fixed rate financing or something, you're just going to do fine. And he said that actually historically that hasn't been the case for homeowners, where actually like the low to middle income people, they actually end up losing money down the road because there are other variables that come into play. So they would be, okay, let's say they seem to be making money on the mortgage, but then they lose their job. And then you actually like kind of fall through. And like, there's like this kind of more complex, other dependencies that may come down with inflation. And then there was like a discussion of, okay, at the end of an inflationary cycle, how does it typically end is well, by having like goods inflation and kind of like, things like food and so forth, like heavily exceeding wage inflation. And that's kind of actually, maybe it's even already the case, but really quote like typical inflationary cycle, like 8 to 10 years. And then at the end of it, okay, becoming kind of like people coming out in the streets and kind of having it overthrowing the government. I mean, I'm not saying that's like a prospect for here, but it's kind of like the historical thing. So it's like a little bit of it's a tricky thing, It's like people tend to think they super benefits. So some interesting sponsors, like with sponsors now, like as well. Okay, everybody thinks or like investors. That's just like private investors. So we're all gonna just benefit from inflation because benefits hard assets. It sounds a little oversimplifying. I mean, one of the things is that I had seen and I kind of like commented before is, well, if we take, let's say the state of Arizona or something, okay, you have like so much like wage inflation and asset inflation, this got so disconnected, but that, yeah, sure, your hard asset is going to appreciate, but then you're going to have downside exposure afterwards. So it's, like pretty tricky because you're going to end up with an overvalued asset that will kind of like, at some point be reflected. And so this is like the tricky part because sure, if like, oh, good stuff like wages and so forth is booming as well and is growing at double-digit numbers, yeah, that's perfect. But if that doesn't happen, then what? Then we're stuck with overvalued assets.
I mean,
so
yeah,
like,
it's you can get really wonky talking about this stuff in terms of just all the different interplay of the different aspects. Frankly, that's economics is social science because I think it's a pseudoscience, to be honest with you.
No, that's true. I agree.
Yeah.
With that.
After all, what's the quote about? There's no such thing as a one-handed economist. They're always saying on the other hand. So there's I don't know if there's necessarily a definitive thing, but one thing is for sure. I mean, we're all profiteering kind of capitalists here. We all are in this business after all to make money. But I don't think that should be. I don't think any of us here are trying to do that at the detriment of the common man. I think at the end of the day, our customers are tenants, and that as a natural byproduct of that, we should be thinking and hoping that they do well. Overall, kind of the middle income wage earner does well, productivity ticks up, and all the supply chain issues subside, and people get back to work, and our economy kind of frees up. So that's kind of I prefer to wear the ever the optimist hat. But that being said, if you are going to put your money somewhere, I think there's no better place right now than real estate. So
I agree.
Mm-hmm. Cool. Okay. Any last questions, guys? If you want to kind of like speak up, one last question before we close up. We're already over time, and Marc and Gonzalo have been very generous with us here today with their time and like answering to all my multiple questions and other people as well.
We could sit here all day talking about this stuff. This is what we love doing, talking about.
Cool.
we got into the nitty gritty. You were dropping bombs there, talking economics, inflation. We covered the whole thing.
Yeah, wow.
We even
Yep.
covered Legos.
Yeah, Legos. That's right.
Lego blocks.
Great. Okay, well,
Hey. No, just right quick, Mark, what was that book you mentioned? Not who, but how, not how, who, but how?
Oh God, now I'm having a hard time.
Not how, but who.
Who, not how.
Who, not how.
There it is.
Who,
That's a
not
good one.
how. huh?
Yeah.
All right.
So what's the best way for people to reach to you? Your website?
Yeah, check
Yeah,
out our
you-
website. Oh, sorry, Gonzalo.
No, I was just gonna say, yeah, if anybody has any interest in seeing what we're up to, just go to investwithmaple.com, and we have some good educational content there, videos of talking about this stuff, and you can also reach out to us on there.
And definitely always love to, as you can tell, talk about this stuff. If anybody ever wants to just chop it up or maybe get a second opinion on a deal or whatever, we by no means have a monopoly on, have good ideas basically. So would love to talk to you about real estate.
Awesome. Okay, thank you guys. Thank you for to everyone as well for joining us here today. Was great. We covered a lot of questions, so I appreciate it. Thanks, Mark. Thanks, Gonzalo.
Thanks for having us on,
Thanks, everyone.
Stefan.
Thanks
Have a good
everyone
night.
for the questions.